Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kate Campbell, welcome to this episode of the Australian Finance Podcast, Investing Month.
It is wonderful to be back, and it has been a month.
It has been a month. Yes, it has been indeed. Today we're talking about an investing checklist. This is probably not the type of checklist you might think of if you've been listening to the show for a long time. We have covered something very similar to this in the past. It's not a stock by stock by stock by stock checklist or what you can look for when you go in for a property inspection. It's more of a general checklist.
Yeah, so if you've listened to all of our episodes on investing over the last month and you've got the building blocks in place now, this is all the things to just keep in mind or think about before you're ready to start investing, and then how to take action, because that's what we're all about here.
Because investing generally seems like a very steep learning curve. I think anyone could say the same. You think it's all just about like ETFs or the stocks that you buy or the property that you invest in, whatever the case is. But there's so much that comes with it. There's admin, there's learning, there's getting the confidence, there's tax, there's, investing in a couple if you share money. There's so many different things to think about, let alone what you've got to learn. So hopefully this checklist helps you just get some of those things in order to give you a pathway and navigate through.
And just make it a little bit less overwhelming. And we have this as a Google Doc, so we'll have that linked in the show notes and the description of your podcast player, so you can just make your own copy and check things off as you go. And if you have anything else you want to add to your own checklist, then pop it in there.
Yeah, you can add it. You can make it, drag and drop it into your own Google Drive account. So just a bit of admin. At the very start of the Google Doc, there is a little thing that tells you how to make a copy of it. If you're not familiar with Google Docs, we get that question a lot. How do I make a copy of this? Can I edit it? Yes, you can. You just need to make your own copy. There is a bit of an instruction there. But the first thing, Kate, in this new investor checklist is, and this is more like a self-reflective one, it says, I know why I'm managing my own money, or like why this is so important to me. So start with why. Sounds like it makes a lot of sense.
Yeah, and it's an important step because many of us think we need to rush into investing before we sort out the foundations. And that's what we've been covering over the last month, figuring out all of those important basic foundations that are really important and are going to stick with you throughout your whole investing journey. And understanding why you're investing and why you want to build wealth and why you want to work on your finances and managing your money better is really important first step, so that when things get hard, when they get tough, when you go, I just don't want to sort out my taxes, I'm going to leave it for a few more months, or I don't want to look at my portfolio, or do I invest this month? Do I not? You know why you're doing it, and that helps you push through when it feels frustrating or hard or challenging, because you know why you're doing it, and that gives you the confidence and conviction to keep going.
Keep going. Stay on the horse or get back up on it. And it's so important because, like you said, unless you know exactly why you want to do something, as soon as something gets a bit more challenging, it's easy just to falter. And that's why we're big advocates of writing things down as well, right? Because people can then go back and they can see it. Like if you just think about it, like, I know why, and then you kind of say it to yourself right now, or you put it on a serviette and then you lose that serviette, you're not going to be able to recall it and kind of critique your prior self, or your future self rather, anywhere near as easily. So the second thing is, I have a list of simple financial goals. How do you go about goal setting, Kate?
Yeah, so even when it comes to your finances, setting one short term, so something you want to save towards in the next 3 to 12 months, something medium term over the next few years, and a longer term financial goal, which might be you're trying to invest
in a forest.
Yes, in a forest. You want to build your portfolio to $100,000, or you want to have $1,000 of passive income from your ETF portfolio every year, or you want to build your super to XYZ level. So working out what your goals are, because that'll help you step backwards and work out, well, how much can I invest each month, given I have 3 different competing priorities right now, and what is my time frame? Because having some goals and understanding that will also show you how long you can invest for, and that will change what you can invest in.
The next 2 things are all about your personal finances, and people don't really think about this as much as they should. Like you said, they like to jump in. I now see a lot of professional investors like fund managers and people like this now talking about the importance of good financial hygiene. And one of those things is actually paying off debt. So we say to pay off debt because the interest rate on debt is basically negative compounding. So when we talk about investing, the reason we invest is so our money compounds, it grows over time, like it feeds on itself. Debt is actually that in reverse. So what we see when interest rates go up, as they have in the last little while, people who have debt go backwards faster and people who don't have debt go forwards faster. And so that's what we see. We see investors get ahead and other people go behind. But people think they can do both. People think they can have a lot of debt and invest, but it actually works out mathematically to be incorrect because the interest that you pay is typically higher than the return you get from investing. Not only that, you pay tax on any gains that you make when you invest. So it's like a double whammy. It's typically not as high and you pay tax. Whereas when you pay off your interest, so you just take that money that you might have otherwise invested, you pay off your debt, you kind of get the best thing in a spreadsheet. But the secondary thing, Kate, which I'm sure you'll talk about, is it makes you feel better.
Yeah. And also paying off debt helps you build solid financial habits, because if you get into that practice of paying $500 off your credit card every month because you've got a plan, you know it's going to take you 12 months to pay off this credit card, and then you're going to close it down and not use a credit card anymore. Once you've paid off that credit card, you can then convert that $500 a month into your savings goal or your investing goal. So you've built that really awesome skill set of regular doing something with your money, and you can just change that skill from paying off debt to investing.
Yeah. And so people think, like when we talk about an investing month, you got to jump straight into it. Sure, you can still do your micro investing. You still do your little bits and pieces like that. But the first focus should be paying off that high interest debt, like buy now, pay later, credit cards, etc. Maybe even loans to family and friends.
And we've got a free course as part of our Rask road trip on Rask Education that you can take that will help give you some different tips and tricks and strategies to working on paying off debt. And there's also free financial counselors you can speak to who will really help look at your individual situation and provide you with a strategy to getting out of debt. And that helps, especially if you have debts with multiple places.
Yeah. So again, we'll just emphasize those are free things, the free course on Rask Education and the free financial counsels that you can contact. The reason why we say to pay off debt first is because you are effectively starting in a negative position. So your personal balance sheet has more debt than it does assets. And slowly over time, as you pay that off, we said before, mathematically it makes sense. Emotionally, it makes sense. But there's another reason. And once you get from kind of like the tip of the iceberg, you kind of emerge from beneath the surface and you've started to pay back your debt, you get to a point where you start to become like asset positive because you no longer have as much debt as you do the assets, like the cash. And what that means is that then you can start to save an emergency fund. So the emergency fund is something that all investors should have every single day of the year. Because even if it's only, a few $1,000s, it means that when things get tough when it comes to investing, or for example, you lose your job, you don't have to sell your investment straight away. And this is what we call a forced seller, Kate. It's when someone has no other reason to sell other than something completely, there's nothing related to investing. It's something else in their life that means they have to sell.
Yeah.
And so that's a really bad place to be in because then you end up selling your investments oftentimes at the wrong time.
Yeah, and often when things are going wrong, maybe in the economy and you've lost your job, maybe you've been made redundant, the market also might not be doing very well at the same time. And then it's sort of a double whammy. So having 3 to 6 months of your basic living expenses, that's not including travel and all of that sort of stuff, stashed away, high interest savings account, some awesome high interest savings accounts right now. So if you're just listening to this and you haven't checked your savings account recently, there are some great rates, like anywhere 4 to 5% per year interest on your savings account. Have a look. Yeah.
And if you have a mortgage, an offset account is typically attached to your mortgage. If it isn't, speak to your mortgage broker or the bank because they'll be able to organize an offset account for you. And that means that you don't make interest, but you save interest on your mortgage. And that's highly tax effective.
Yeah, just find ways to make your money work for you.
Yeah, absolutely. So the next thing is this idea of investing in your education, because a lot of people say to us, Kate, well, interest rates are high, cost of living pressures, etc. I don't have enough money to invest yet. I'm paying off this debt or whatever. And they're doing all the right things. But then like, what can I do now to try and, develop and whatever? And we say, well, you can still learn. Like knowledge is free.
Learning is something you have control over. You can put 30 minutes, whatever you can spare, aside in your calendar each week. And you spend that time, whether it's reviewing your budget for the month or it's taking one of our free courses and going, okay, this month I'm going to learn about property, or this month I'm going to learn about my superannuation and take some actionable steps to improve my future situation. So prioritizing learning, because I think this is something that, especially at the beginning of your journey, every half an hour you spend learning will return substantially more in terms of not making mistakes, in being able to invest, in even just some small changes you make with your super. We talk about that a lot on the show, can have huge impacts over your lifetime. So I would really encourage you to prioritize just half an hour each week or each month, whatever you can spare for your own financial learning. Yeah,
we often hear from people that have gone on this journey, and some people try and go out there and just like a horse out of a gate, so to speak. It's just like racing out, and they try and consume as much financial information as possible to get it done. And that might work for some people, but for a lot of people, this stuff isn't that interesting. But it's important. Like it's important for everyone, obviously. So the way to do that is just to do a little bit, often. And that could be through podcasts. It could be through a book. It could be, we have book lists on the website. We have free courses. It could just be ticking off one of those things every day. But just a few minutes every week is fine.
And most of us have some things on our list that we've put off for years and years. I mean, I was speaking to someone earlier today who knew he wanted to sort his will out because he'd bought a property and he has some assets now, and he'd been talking about doing that for years and years and years, and he still hasn't done it. So there's a lot of things that in all of our lives we can probably identify that we put off for a long time, but we know we should do it. So it's about putting yourself first and your own financial future first, and making time for these important things.
Yeah, because like health, it's important to understand at least the basics. And I'd say after a few months, most people have a really good grasp of the essentials of finance and investing. So we have this checklist here, and I'll read it out. It's part of the Google Doc, and there are 4 items on there that we want you to understand. So we say, I have an understanding of the following, and you can tick these off in your own time. I understand that the stock market won't go up every year. Why, Kate?
Because the stock market doesn't always go up. And if you have a look at how different asset classes like Australian shares have performed over time, it is a roller coaster ride. Things will go up, things will go down over time. Over the last sort of 50 years, things have gone up, but not at every moment. So this is important to have an understanding of, because if you make your first investment of $100 in an ETF today, and tomorrow you log into your account and it's $95, we don't want you freaking out and going, oh, I've made a mistake. I've made the wrong decision. My money's gone backwards. Therefore, I did something wrong. Because part of investing is that things go up and things go down. We're investing for a very long period of time, because over time, we believe Australian companies will grow. Yeah. But not going to happen necessarily tomorrow.
Yeah. We're students of history. On average, the market will fall. If you just go by calendar years, on average, the market will fall one in, say, every 5 years. And that can be quite dramatic when it happens. It can be 20%, it can be more. But over those other 4 years, you get, on average, positive returns. But notice how it's on average. Sometimes that one bad year could be 3 times in a row, and then you've got 10 years of positive market. And at the end of the day, it comes back to between, let's say loosely, an average of 5 to 10% per year. So you go through all of that, all the trials and tribulations just for an average return of 5 to 10%. But in the meantime, it could do a lot of different things.
If I see my portfolio go down 30% and suddenly all of that hard-earned money that I've put in has gone down in value, if I freak out and sell, then that can impact my financial future for years to come.
Yeah.
But if I make the decision to go, okay, I'm sticking to my plan, I don't think anything fundamental has changed, I'm either going to not invest anymore but not sell, or I'm going to invest more. That could also set me up for years to come.
Absolutely, it could. That's why we say little bits lots of times, right? So the second thing is I have an understanding of the following, that everyone is unique in how they think about risk. So it's called a risk profile. We think that everyone will have different life experiences, and those experiences shape our attitudes towards money. So whether you think investing is a positive or a negative thing, and that ultimately informs how we should invest.
Yeah, and that's why we talk so much about understanding our money story and our relationship with money growing up, and how our parents talk to us about money, how we talk about it with our friends, even financial psychology on this show, because that often impacts the decisions we make and how comfortable we feel investing money, and whether we can cope with thinking 5, 10, 20 years out when we're investing.
Yeah. The finance industry, for those that don't know, is obsessed with this idea called volatility, which is that random up and down that we mentioned before. It doesn't go up every day kind of thing. We call this volatility. And that's the official definition of risk in investing. But my definition of risk would probably be something like, I don't save and invest enough money to reach my goal. So if my goal is to own a farm, for example, in years to come, I don't have enough money when I get there. To me, that would make the most sense. Of like, in my mind, that would be what risk is. Like, financial risk, I don't have enough money.
Yeah, for me, it's probably not. If I would be taking a huge risk if I'm investing in something I don't understand, that I can't explain how it works and what it does to a friend or family member.
Yeah, see? And there's so many different versions of this. But I think at the end of the day, people just want to be comfortable with what they're doing. Like, they know that it doesn't go up every day or every month or every year. And they know that there's like a good solid track record and history of this thing. It's not a gamble, so to speak. And so this is what we believe. This is why we invest, because of these reasons. Like, we do want to invest in what we know and invest for the long term. Speaking of, the next thing, the third part of the 4-part checklist is that I understand the stock market is for 5 to 10 year money only. Kate, what does that mean?
So like we mentioned that the stock market won't go up every year. This means that if I'm investing, I only want to be investing money that I can put aside for a long period of time. So it's those long-term goals. Yep. So I don't want to be investing a house deposit if I'm planning to buy in the next few years. I don't want to be investing my emergency fund because I need that money accessible immediately if something goes wrong. I don't want to be investing my money for my European holiday next year. So I only want to invest money that I know I can put aside for at least 5 to 10 years, hopefully more, like our superannuation. So that is money that I'm not going to need for decades, so I can afford and I can take more risk and I can invest in a higher risk super fund. Yeah,
absolutely. So why do we put ourselves through all of this? Well, the final part of this mini checklist within the main checklist is I have an understanding of the following, that stocks are risky, but over 10 years can grow well. And so the reason that we invest in the stock market, or that we invest via ETFs, is because historically the stock market has been an exceptional way to make money and grow wealthy. And those who invest get ahead, and those who don't invest don't get ahead, at least nowhere near as quickly. And so we put ourselves through all of that pain to come out the other end knowing that it's the best place to put our extra dollars.
Yeah, because we're buying companies, and companies don't double in size overnight, but over 10 years, they can create new products and services. They can sell new things. They can employ more people, expand their offices. So this takes time though.
Yeah. And Warren Buffett has this really interesting saying. He says, in the short term, stocks are risky. In the long term, stocks are risky not to invest in. With the idea being that the longer you have to invest, the less importance you place on those short-term emotional issues that comes with investing, and the more you begin to realize that you're just investing in businesses, and businesses are creating value for society.
Yeah, because we don't want to just be consumers of the economy. We're buying services and goods every day, but we could also become part owners. So by buying and investing in ETFs like we talked about this month, and we might be investing in a whole basket of Australian companies that we're using their products and services of every day, you get to be part owner of that. So if that company does well over time, because every other Australian is also using their products and services, you get to benefit from that growth.
Absolutely. So we've got 3 more things on our big checklist which you can download. And it's a pretty simple one. This one's a bit self-serving, but we would love for you to tick this box off, which is I have listened to the Investing Month episodes on the Australian Finance Podcast. Obviously, we've been spending this entire month talking about investing and how important it is. We would love for you to be able to tick off everything because we think all of the episodes are really important for anyone that's looking to get started or accelerate their investing.
Yep. And the next one, if you are interested in ETFs specifically, because each of the episodes this month was very sort of brief, concise overview because we wanted to cover a lot of ground.
Yep.
If you are interested in exchange traded funds and investing in those baskets that we talked about, so I could have a basket of Australian shares or a basket of US shares, I want you to listen to our ETF investing mini-series that we did last year. It's 5 parts. It's super educational. We use favorites. We use fake money. Our producer Monique's there, and we're sort of having a 3-way transaction to explain how ETFs work. And so that will give you a really, really good understanding of how ETFs work, and you've got that knowledge for life.
Yeah, and it's a really, we think it's a great way to get started investing. So the final thing, Kate, and this is the one where people they're like ready to go, they're pumped up, they get out their phone or they're on the computer and they think, okay, I'm ready to do this thing. What do I pick? Which one do I go with? Which broker? What platform do I use? How do I actually buy them? So instead of saying to you, go and do this one thing, we're going to tell you to do 2 things. We're going to tell you to download 2 brokerage accounts or apps, or go to their website and create 2 accounts on separate ones and try them. Some of the most popular names include CommSec, which is the biggest in Australia. I've got Perla, who is a sponsor of the Australian Finance Podcast. Stake. We've got Self-Wealth, which is not so much a sponsor, but we do educational things for them. Superhero, Sharesies, and even Vanguard have their own brokerage platform these days. There's NAB Trade and a few others.
Yeah.
Download 2 of them, the apps, or create 2 accounts and see which ones you like.
Give them a go, and then also give yourself a time frame to make a decision. So if you are trying a few different brokerage accounts, say by the end of next fortnight, I will make a decision. I will choose one of these and I will proceed with that. Because even if you don't like it in 6 months' time and find a better option, you can just change brokers. You can transfer any shares from broker to broker. Yeah,
so just change. It's not something that's irreversible. A lot of people create one account and I find it really time-consuming and mentally exhausting to try and decide if that is the right choice for me right now. Well, maybe it is right now, but maybe in a year it's different, so then you can change.
And that's why we suggest starting really small as well. So you're not getting your whole $100,000 life savings and investing today. You're going to start with $5 if it's a micro-investing app, or $500 if it's one of these other brokerage apps.
Yeah, we have a full guide available on our website, which is linked in this checklist. And it will take you through the most popular in our community. We don't receive anything for mentioning these brokers, by the way, but it gives you an overview of the costs and what you can expect from them and how they work. And it's seriously, just go and try them. All of them that we've mentioned are free to open. There's no cost associated with opening an account. And some of them even give you like a tiny little bonus just to get started or something like this. So go and check them out.
Find a friend to refer you. Maybe you'll get $10 credit or something like that.
Yeah.
We don't do referral codes here, but your friend might have one.
Yep.
But I think the great thing is everything we've talked about in today's episode and throughout the month, if you want to go further and go more in depth, we have courses on everything to do with ETFs, and we've got our mini series on the podcast. If you want to learn about individual share investing, last month we did a shares month and we have a checklist. So if you want to start researching shares, you can go through that checklist. If you want to learn more about risk, we've done episodes on that, compound interest.
Yep.
We've done episodes and we've got guides diving into brokerage accounts. So take what you're interested in, search for our back catalogue, whether it's on the Finance Podcast or our other yellow one, the Investing Podcast, and go to Rask Education. We've got about 15 free courses, so you can't go too far wrong.
Yeah, and they're free. Yeah. So check them out. We've enrolled, I think, nearly around 24,000 students in the courses, which is just unbelievable.
Yeah.
We also, just to add on top of that, we also have 4 different podcast channels, right? So if you're just interested in property, go and listen to our property podcast. If you're just interested in business, go and check that out. We've got so much we do and we just love to share it with you. But this guide is a great way, this checklist is a great guide to navigating you through to your first investment or continuing your investment. And we speak to people when we're at events. They've been listening to us for years and haven't invested. Literally years they've been listening but haven't invested. And that is okay. Now is the time.
Yeah.
Now is the time.
I think the thing we haven't put on this checklist is just that investing is a fantastic thing to do.
Yeah.
And it's a fantastic step that you're taking for your financial future. And if you think about it, you're already an investor. You've got superannuation. I'd say 99.9% of people listening do have a superannuation, a retirement account in Australia. And that is already investing in shares and bonds and property in Australia and globally. So you are an investor. So this is just another step you're taking as part of your own financial journey.
Yeah. So let's recap. This is the checklist. I know why I'm managing my money and why it's important to me. Obviously, you want to retire on your own terms or do whatever you want. I have a very simple list of financial goals. Could be very simple. Could be just a couple of things if you want to. I have paid off my bad nasty debts, those high interest ones.
Buy now, pay laters as well.
Credit
Personal
cards.
loans. If you have a loan to friends and family, get that off your back.
Yep. I have an emergency fund, 3 to 6 months of living expenses, but that can also depend. If you're a single income family with kids, you might want a little bit more. If you're in retirement, you've got your house paid off, you might want a little bit less, but you might put it in a different place.
Yeah. Have you scheduled 30 minutes in your calendar to work on your finances each week, whether it's learning or actually taking action?
Yep. Speaking of learning, I understand the following, that the stock market won't go up every year, that everyone is unique about how they think about risk, so you should think about that for yourself. I understand that the stock market is for long-term money only, and that stocks are risky, but over the long term, they can grow very well.
I've listened to the Investing Month series on the Australian Finance Podcast, and if there was something that interests me, I scrolled back through the episodes to dive in deeper.
Yep. And of course, we have an ETF mini-series, and our ETF course itself, which is free, is our most popular of all time. So we have an ETF series with Monique, our producer, who was in the studio with us with some chocolates, and we've got a course to back it up if you want to get involved in that. And finally, Kate,
I've downloaded and tested at least 2 brokerage accounts, and then I've set myself a time frame to make a decision.
Yep.
And you can have a look at our guide for more details on how to compare and choose brokerage accounts on Rask Media, but we'll have that in the show notes.
Yes, so much to go with. We'll have all of the links in the show notes, but definitely, please, if you haven't taken a moment to really get that emotional hurdle out of the way and actually start investing, this is the way to do it. Just have a checklist that we've created for you. Just follow it. It doesn't cost anything to follow this. It's really simple. And within the month, you can be an investor just like us, and you can begin overcoming that fear of investing for the first time and start to feel confident in yourself and in your future.
Amazing.
Yeah, great. Well, Kate, this has been a great episode for Investing Month. Thank you so much for joining me.
Thanks, Owen. See you next time.